Three ETFs, all paying monthly income. But the difference between what you actually keep at the end of the year versus what the yield number suggests is the gap that most investors never calculate before they put their money in. Here's the real math on JEPI, JEPQ, and SCHD. Before the numbers, one thing needs to be established up front because skipping it makes the rest of this comparison meaningless. These three ETFs do not generate income the same way. They use three entirely different mechanisms to produce the distributions you see hitting brokerage accounts each month or quarter. And that difference in mechanism is what determines not just how much you receive, but how reliable that income is, how it is taxed, and whether it grows over time or slowly shrinks. How each ETF actually generates income. JEPI is the JP Morgan Equity Premium Income ETF, launched in May 2020. It holds a portfolio of large-cap U.S. stocks with a defensive tilt, meaning it leans toward lower volatility companies rather than pure S&P 500 weighting. On top of that stock portfolio, JP Morgan sells what are called equity-linked notes, which are structured products tied to S&P 500 options. The premium income from those notes gets passed to shareholders as monthly distributions. JEPI carries an expense ratio of 0.35% according to JP Morgan's fund prospectus. JEPQ is the JP Morgan Nasdaq Equity Premium Income ETF, launched in May 2022. It works the same way as JEPI, but uses Nasdaq 100 stocks as the underlying portfolio instead of the more defensive large-cap blend. Because the Nasdaq 100 is more volatile than the S&P 500, the option premiums that can be collected are larger, which is why JEPQ consistently pays a higher yield than JEPI. It also carries a 0.35% expense ratio per JP Morgan's fund documentation. SCHD is the Schwab U.S. Dividend Equity ETF, launched in October 2011, making it substantially older than both JP Morgan products. SCHD tracks the Dow Jones U.S. Dividend 100 Index, selecting 100 companies that have paid consecutive dividends for at least 10 years and pass quality filters on free cash flow, return on equity, and dividend yield relative to peers. There are no option strategies, no structured notes, and no derivatives. SCHD generates income the old-fashioned way, by owning companies that pay and grow dividends. Its expense ratio is 0.06% per Schwab's fund prospectus, which is the lowest of the three by a significant margin. The monthly income math on $100,000. This is the number most people start with, and it is where the comparison looks most favorable for the JP Morgan funds. Using approximate current yields based on trailing 12-month distribution data, JEPQ has been yielding in the range of 9 to 11% annually. JEPI has been yielding in the range of 7 to 8%. SCHD has been yielding in the range of 3.5 to 4%. All three yields fluctuate, and past distributions do not guarantee future payments. On a $100,000 portfolio, using the midpoints of those ranges, JEPQ at 10% generates approximately $10,000 per year, which comes out to roughly $833 per month. JEPI at 7.5% generates approximately $7,500 per year, or about $625 per month. SCHD at 3.7% generates approximately $3,700 per year, but it pays quarterly rather than monthly, which means approximately $925 arriving every 3 months rather than a monthly deposit. If immediate monthly cash flow is the only variable that matters, JEPQ wins this comparison, and it is not particularly close. What happens to the principal, the variable most people skip? JEPI and JEPQ generate their elevated yields by selling option premium on their underlying portfolios. That strategy has a structural cost. It caps the upside participation in rising markets. When the S&P 500 or Nasdaq 100 rises strongly, covered call and option premium strategies give up a portion of that gain because the options they sold get exercised. This is not a flaw in the product, it is the deliberate design. You receive higher monthly income in exchange for lower total return in strong bull markets. Between JEPI's launch in May 2020 and the end of 2024, JEPI delivered a total return of approximately 32%, including all distributions reinvested, according to Morningstar data. Over the same period, the S&P 500 delivered a total return of approximately 105%. JEPI gave up significant capital appreciation to deliver its elevated monthly income. JEPQ, being tied to the NASDAQ 100, which recovered aggressively from its 2022 lows, has shown stronger total return than JEPI over its shorter history, but still lags the NASDAQ 100 index itself in total return terms. SCHD, with its lower yield and no options overlay, participates more fully in long-term market appreciation. Since its October 2011 launch through the end of 2024, SCHD delivered a total annualized return of approximately 12 to 13%, including dividend reinvestment according to Morningstar data, broadly comparable to the S&P 500 over that same period, while generating growing income along the way. The dividend growth math, where SCHD catches up. SCHD's yield of 3.7% looks unimpressive next to JEPQ's 10% in the short term. Over a 10 to 15-year horizon, the picture changes in a way that most yield comparisons never show. SCHD has historically grown its dividend at approximately 10 to 12% annually since its 2011 inception, according to Schwab's historical distribution records. If that growth rate continues, an investor who buys SCHD today at a 3.7% yield would have a yield on their original cost basis of approximately 9.6% after 10 years of compounding at 10% annual dividend growth. That means the income from SCHD on the original $100,000 investment reaches JEPQ's current yield level in roughly a decade, while also having benefited from capital appreciation on the underlying portfolio during that entire period. JEPQ and JEPI distributions are not designed to grow over time. They fluctuate based on options market conditions, implied volatility levels, and interest rates. In low volatility market environments, the option premiums that fund these distributions compress, which is why JEPI and JEPQ distributions can decline during calm markets even when stock prices themselves are rising. An investor who counted on JEPQ's 10% yield remaining stable for the next decade is making an assumption the fund's structure does not support. The tax efficiency difference. This dimension is one that most yield comparisons ignore entirely, and it meaningfully changes the after-tax income picture for investors in taxable brokerage accounts. SCHD's distributions are predominantly qualified dividends, meaning they are taxed at the lower long-term capital gains rate, which ranges from 0 to 20% depending on your income bracket, according to current IRS tax schedules. For someone in the 22% ordinary income bracket, qualified dividends are taxed at just 15% instead. JEPI and JEPQ distributions include a meaningful portion classified as ordinary income rather than qualified dividends because the income derives from equity-linked note premiums rather than directly from company stock dividends. Ordinary income is taxed at your standard marginal rate, which can reach 37% in the highest bracket. For an investor in a higher tax bracket holding JEPI or JEPQ in a taxable account, a portion of the yield advantage disappears once taxes are applied to each monthly distribution. This is why both funds tend to work better inside a Roth IRA or traditional IRA, where the tax treatment of each distribution does not create an annual drag on after-tax income. The verdict. On raw monthly cash flow from the same invested amount right now, JEPQ pays the most, JEPI pays the second most, and SCHD pays the least. That is accurate, and the math confirms it clearly. But the more complete answer is that each fund is built for a different investor situation. JEPQ is the right tool for someone who needs maximum current income today, accepts that income will fluctuate with market conditions, and is holding it inside a tax-advantaged account where the ordinary income tax treatment does not create an annual drag. JEPI serves a similar purpose with somewhat less volatility in its monthly distributions. SCHD is the right tool for someone with a longer time horizon who wants income that grows predictably every year, values the tax efficiency of qualified dividends in a taxable account, and is willing to accept a lower starting yield in exchange for both capital appreciation and rising income over time. Many experienced income investors hold two or three of these funds together for exactly this reason. Pairing SCHD for long term dividend growth with JEPQ for current monthly cash flow covers both dimensions without requiring any single fund to do a job it was not engineered to handle. The yield number on a fund page tells you what you might receive today. The total return history, the distribution reliability, and the tax treatment tell you what you actually keep over time. Running all three comparisons before choosing between these funds is the difference between chasing a number that looks good on a screen and building an income stream that holds up across different market environments and tax situations. But if this breakdown helped you understand what truly separates these three ETFs beyond the headline yield, subscribe, because every week we run the actual math on the investments that millions of people hold without fully understanding how they work.